23 years. That's how long gold took to recover from its 1980 peak. Investors who bought at $850 in January 1980 waited until 2008 to see those prices again. 23 years of patience, 23 years of doubt, 23 years of wondering if they'd made the worst financial decision of their lives. But here's what those investors didn't know. Those who bought during the 1980 crash, not at the peak, but during the collapse, those who accumulated when blood was in the streets, they didn't wait 23 years. They captured gains far sooner. And those who understood why they owned precious metals in the first place never panicked regardless of price. The shock just happened. Gold and silver crashed. Portfolios bled. And right now, millions of investors are asking the same questions. Should I sell? Should I buy more? Should I hold? Did I make a mistake? Is this the end or the beginning? These are the wrong questions. Long-term investors don't ask what to do after a shock. They already know. Because they understood before the shock why they owned precious metals, what role those metals play in their portfolio, and what time frame they're actually operating on. If you're confused right now, if you're uncertain, if you're questioning your precious metals position, this video is for you, because after the shock is exactly when clarity matters most. By the end of this video, you'll understand why long-term precious metals investing is fundamentally different from trading, what history teaches us about post-shock recoveries, how to think about your position in proper context, and what actions actually make sense for investors with multi-year time horizons. Because the traders are panicking, the speculators are liquidating. But long-term investors, they're doing something entirely different. Welcome to the silent economy. Let's bring clarity to the chaos. Before we go further, I need to establish a framework that separates long-term investors from everyone else in the precious metals market. This distinction is critical because the advice that makes sense for traders is catastrophic for long-term investors, and the approach that builds wealth over decades looks foolish over weeks. Here's the framework. There are 3 categories of precious metals participants, and they require completely different approaches. Category 1, traders. These are short-term participants. They're trying to profit from price movements over days, weeks, or months. They use leverage. They watch charts. They react to Fed announcements and economic data. For traders, the recent shock was an event to navigate. Cut losses. Reposition. Find the next trade. Traders live and die by price action. A 15% decline is potentially catastrophic if leveraged. Their time frame is too short to wait for recovery. Category 2, speculators. These participants have slightly longer time frames than traders, but are still primarily focused on capital gains. They might hold for months or a few years. They're betting on precious metals going higher. Speculators are wounded by shocks, but not necessarily destroyed. They're asking whether the bull market is over, whether they should cut positions, whether better opportunities exist elsewhere. Category 3, long-term investors. This is a fundamentally different category. Long-term precious metals, investors aren't primarily betting on price appreciation. They're holding precious metals as a permanent portfolio component for specific strategic reasons. Wealth preservation across generations, currency debasement protection, portfolio insurance against systemic risks, diversification away from financial assets. For long-term investors, the recent shock changes nothing fundamental. The reasons they own precious metals haven't changed. The role precious metals play in their portfolio hasn't changed, only the price has changed. And price, for a truly long-term investor, is information about accumulation opportunities, not a signal to abandon strategy. Now, here's the framework for thinking about post-shock behavior as a long-term investor. Principle 1, time horizon, determines emotional response. If your time horizon is 20 years, a 20% decline is noise. You'll experience multiple such declines across your holding period. Reacting emotionally to each one is exhausting and counterproductive. If your time horizon is 2 months, that same decline is potentially devastating. Know your actual time horizon. Let it govern your response. Principle 2, purpose, determines position. Sizing long-term investors size their precious metals positions based on portfolio allocation strategy, not based on expected short-term gains. A common framework is 5 out of 15% of total portfolio in precious metals for diversification and insurance purposes. This percentage is maintained regardless of short-term price action. When you're properly sized, shocks don't threaten your financial stability. They're uncomfortable, but survivable. Principle 3, accumulation versus speculation. Long-term investors are accumulators, not speculators. They add to positions over time, often using dollar-cost averaging or value averaging approaches. Shocks, for accumulators, are opportunities to acquire more ounces at lower prices. The cheaper the price, the more ounces per dollar invested. This psychological reframe is essential. Accumulators welcome lower prices during their accumulation phase. Principle 4, Physical versus paper. Long-term investors typically emphasize physical metals or direct ownership structures. They're not trading futures or leveraged ETFs. Physical gold and silver have no counterparty risk. They can't go bankrupt. They can't be diluted. They've maintained value for thousands of years across every civilization. Paper price shocks don't affect the fundamental nature of physical metal you hold in your possession. Let me show you how long-term investors have navigated previous shocks. Example 1. The 1980-1982 shock and long-term recovery. January 1980, gold peaks at $850, silver at nearly $50, the most spectacular precious metals mania in modern history. Then the crash. Gold fell to $300 by 1982, a 65% collapse. Silver crashed even harder, falling below $5 eventually, and over 90% destruction of value. Traders were destroyed. Speculators were wiped out. The Hunt brothers went bankrupt. But what about long-term investors? Let's examine different scenarios based on the framework. Investor A bought at the peak, $850 gold, and panicked. Sold at $400 in 1981, locked in a 53% loss. Never returned to precious metals. That loss was permanent. Investor B bought at the peak, but understood the long-term framework. Held through the crash, held through the 1980s, held through the 1990s. By 2008, was break-even. By 2011, was up 126%. By 2024, was up over 200%. But the most successful was Investor C. Investor C didn't buy the peak. Investor C was accumulating throughout, some purchases at high prices, some at low, dollar cost averaging across the cycle. By the time gold bottomed in 1999 at $250, Investor C had accumulated significant ounces at an average cost far below peak prices. When gold rallied to $1,900 in 2011, Investor C had captured enormous gains. The shock of 1980-82 was devastating for traders. For long-term accumulators, it was an opportunity to acquire ounces at lower prices during a multi-decade accumulation strategy. Time frame determined outcome. Example 2, the 2008 financial crisis, Shock March 2008. Gold had just touched $1,000 for the first time in history. The precious metals bull market seemed unstoppable. Then came October. Lehman collapsed, global financial panic, liquidity crisis. Gold crashed from $1,000 to $680, a 32% decline in weeks. Silver fell from $21 to $9, over 55% destroyed. Traders with leveraged long positions were liquidated. Speculators who had bought near the highs faced margin calls and mounting losses. But long-term investors experienced something different. Those who understood that precious metals were portfolio insurance watched their insurance policy fluctuate in paper value, while the assets it was insuring, their broader portfolio, collapsed even more dramatically. Stocks fell 50%, real estate imploded, credit markets froze. The entire financial system teetered on collapse. In that context, a 32% decline in gold was relatively modest, and it was temporary. By 2009, gold had recovered fully. By 2011, it hit $921. Investors who held through the 28 shock saw their positions more than double from pre-crisis levels. More importantly, those who recognized the 2008 crash as an accumulation opportunity captured even larger gains. Gold at $680 in October 2008 proved to be one of the greatest buying opportunities in precious metals history. Silver at $9 was even more spectacular. Long-term investors who maintained their framework, who understood their purpose for holding, who used the crash for accumulation rather than panic selling, were rewarded enormously. Example 3, the 2013 flash crash, an extended bear market. April 2013. Gold flash crashed from $1,150 to below $1,350 in 48 hours, the most violent decline in decades. But unlike 2008, this wasn't a temporary shock. Gold continued falling. By December 2015, it hit $1,050, a 45% decline from the 2011 highs. This was the true test for long-term investors. Traders had long since exited. Speculators were defeated. Media declared the gold bull market dead. Analysts predicted further declines to $800 or lower. What separated successful long-term investors from failed ones during this period? Those who failed made several mistakes. They had concentrated positions, sized for speculation, not long-term holding. They had bought with borrowed money or leveraged products. They had expected continuous appreciation rather than accepting volatility as inherent. Those who succeeded maintained the framework. They viewed precious metals as permanent portfolio insurance, not a trade to be exited. Their position sizes were sustainable through extended drawdowns. They continued accumulating at lower prices, recognizing more ounces per dollar invested. By 2016, gold had bottomed and begun recovering. By 2020, it hit new all-time highs. By 2024, it exceeded $400. Investors who accumulated throughout the 2013-2015 bear market at prices between 150 and 1,350 captured extraordinary returns when the market turned. The bear market was a gift to accumulators with long time horizons. It was only a disaster for those with short-term orientations. Example 4. The March 2020 COVID shock. March 2020. Global pandemic panic. Everything crashed simultaneously. Stocks, bonds, commodities, precious metals. The ultimate liquidity crisis. Gold fell from $980 to $1,450 in days. Silver collapsed from $18 to under $12. A 35% silver crash during what should have been the perfect environment for safe haven assets. The irony was stark. A global crisis, massive money printing announced, financial system under stress, and precious metals were crashing. Traders were stopped out. Speculators were bewildered. The narrative seemed broken. But long-term investors understood what was happening. Forced liquidation across all asset classes to meet margin calls. Everything sold together. The price action reflected liquidity mechanics, not fundamental value change. Those who maintained the framework recognized that the reasons to own precious metals hadn't weakened. They had strengthened. More money printing, more debt, more currency debasement, more systemic risk. The crash was opportunity. Gold hit new all-time highs above $2,000 within 5 months. Silver more than doubled from its panic low. Investors who sold during March 2020 panic locked in losses at the worst possible moment. Investors who held, or better yet, accumulated, captured one of the fastest recoveries in precious metals history. The pattern repeats. Shocks create panic. Panic creates selling. Selling creates opportunity. Long-term investors who maintain their framework capture that opportunity. Now let's apply this framework to the current situation. Gold and silver just experienced a significant shock. Prices declined rapidly. Portfolios lost value. The natural human response is fear, doubt, and the urge to act. But before acting, let's work through the framework. First, what is your actual time horizon? If you're holding precious metals as a trade, hoping to profit over the next few months, the calculus is different than if you're holding for the next 20 years. For traders, stop losses, position adjustments, and tactical moves make sense. That's a different strategy requiring different analysis. But if you're a long-term investor, ask yourself honestly, has anything changed about your time horizon because of this price move? If you plan to hold precious metals for decades, does a multi-week decline change that plan? If not, your response should reflect your unchanged plan. Second, what is your purpose for holding? Review why you own precious metals in the first place. If you own them as portfolio insurance against currency debasement, systemic risk, and monetary instability, have those risks diminished? Government debt levels haven't decreased. Central bank balance sheets remain elevated. Currency printing capacity remains unlimited. Geopolitical tensions persist. The fundamental reasons to hold precious metals as insurance are unchanged or strengthened. If your purpose was speculation on short-term price gains, that's a different calculation. But long-term investors should assess purpose, not just price. Third, is your position sized appropriately? This is the critical question that determines whether shocks are survivable or devastating. If precious metals represent 515% of your total portfolio, a 20% decline in metals represents a 1 in 3% decline in your overall wealth. Uncomfortable, but not destabilizing. If precious metals represent 50% or more of your portfolio, or if you've used leverage, a shock of this magnitude can be devastating. This suggests position sizing was wrong for a long-term approach. Be honest with yourself. If this shock has caused genuine financial distress, your sizing was speculative, not strategic. Learn from this for future positioning. Fourth, are you in physical or paper? Long-term investors typically hold physical metal or the most direct ownership structures available. If you hold physical gold and silver, the recent price shock hasn't changed what you own. You have the same ounces today that you had before the shock. Those ounces have the same properties, the same history, the same fundamental characteristics. The paper price fluctuated. The metal remains. If you hold leveraged ETFs, options, or futures, the calculus is different. Those instruments have time decay, counterparty risk, and structures unsuited for long-term holding. Consider whether your vehicle matches your stated strategy. Fifth, is this an accumulation opportunity? For long-term investors in their accumulation phase, lower prices mean more ounces per dollar invested. If you've been wanting to add to your position, the post-shock environment offers lower entry points than pre-shock. This isn't timing the bottom, but it's recognizing that lower prices benefit accumulators. Consider whether your financial situation allows for continued accumulation. If it does, lower prices are advantageous, not alarming. The current fundamental landscape. Let me address what hasn't changed despite the price shock. Global debt levels remain at historic highs. U.S. national debt exceeds $36 trillion. Government debt to GDP ratios across major economies remain elevated. Central banks continue accumulating gold at record pace, over 1,000 tons annually in recent years. They're not selling into this weakness. Reports indicate continued buying. Currency debasement over time remains virtually certain given debt levels and political incentives. The mathematics of debt repayment through monetary inflation remain compelling. Geopolitical tensions persist across multiple regions. Economic uncertainty remains elevated. The fundamental case for precious metals as long-term portfolio insurance is unchanged by recent price action. Only the price has changed. Let me address the objections you might be feeling. But what if this is the beginning of a major bear market like 2013, 2015? It might be. Long-term investors should be prepared for that possibility. Bear markets in precious metals can last years. But here's the key insight. Long-term investors survive bear markets through proper position sizing and purpose clarity. They don't thrive because of perfect timing. If your approach requires avoiding bear markets, you're speculating, not investing for the long term. I can't afford to wait years for recovery. This suggests a mismatch between your stated strategy and your actual situation. Long-term investing requires capital you won't need for extended periods. If you need this money soon, precious metals may not be appropriate for that portion of your wealth. Be honest about your actual circumstances. Not all money is suitable for long-term precious metals allocation. The opportunity cost is too high. My money could be elsewhere gaining value. Long-term precious metals investors don't evaluate based on opportunity cost versus other assets during short periods. They evaluate based on the role precious metals play in portfolio construction. Insurance isn't expected to outperform investments. It's expected to provide protection when other assets fail. If you're measuring precious metals purely against stock returns, you're misunderstanding the purpose. Gold is just a rock. It doesn't produce anything. It's outdated. Gold has maintained value for over 5,000 years across every civilization. Every fiat currency in history has eventually failed. Every paper monetary system has eventually debased. The track record suggests gold's monetary properties are robust, not outdated. Central banks hold gold precisely because of these properties. Their continued accumulation suggests they view gold as relevant, not archaic. Here's what long-term investors should actually do after the shock. First, reassess your time horizon honestly. Write down when you expect to need this money. If it's less than 5 years, reconsider whether precious metals are appropriate. If it's 10 years or more, let that time frame govern your emotional response. Second, review your position sizing. Calculate what percentage of your total wealth is in precious metals. If it's within a sustainable range of 5 to 15%, the shock shouldn't destabilize you. If it's larger, consider whether rebalancing towards sustainable allocation makes sense. Third, reconnect with your purpose. Write down why you own precious metals. Read it during shocks. If your purpose was long-term wealth preservation, currency debasement protection, or portfolio insurance, nothing has changed. Fourth, avoid panic decisions. Don't sell into shock-driven weakness unless your circumstances or analysis have genuinely changed. Panic selling locks in losses at maximum pain points. Fifth, consider accumulation if appropriate. If you're in accumulation phase and have capital available, lower prices mean more ounces. Dollar cost averaging removes the pressure of timing decisions. Sixth, focus on ounces, not dollars. Long-term precious metals. Investors often think in terms of ounces accumulated rather than dollar value. Your ounce count doesn't decline during shocks. Only the paper valuation fluctuates. Seventh, maintain perspective. Zoom out on your charts. Look at gold and silver over decades, not weeks. The recent shock becomes a small fluctuation in a larger context. This is the silent economy. The shock happened. The prices fell. The panic spread. But long-term investors don't navigate by panic. They navigate by framework. They understand their time horizon. They know their purpose. They've sized their positions for sustainability. Every historical shock I've shown you eventually resolved. The 1980 crash, the 2008 crash, the 2013 crash, the 2020 crash. Each one felt like the end at the time. Each one proved to be a chapter, not a conclusion. The traders will trade. The speculators will speculate. But long-term investors will hold and accumulate and wait, because that's what long-term means. If this framework brought clarity after the chaos, subscribe and hit the notification bell. Next week, we're breaking down exactly how to structure a precious metals position within a diversified portfolio, what percentage allocations have historically performed best, and how to rebalance through volatility. Drop a comment below. Are you a trader, speculator, or long-term investor? How did you respond to this shock? What will you do differently going forward? I read every comment. Shocks test conviction. They reveal whether your strategy was genuine or merely untested. They separate those who understood from those who were pretending. Now you have the framework. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.